I'm about to let you in on my secret strategy that I used in the last bull market to exponentially grow my crypto portfolio without physically buying more crypto. And I did it on low leverage, which makes this super safe. As an example, in the last bull market, I originally invested $1,500 into DOT and I turned that into over $14,000. I started with 151 DOT and I ended up with 359 DOT, and I never actually bought more of it. In this video, I'm going to show you exactly how I did that. First things first, you're going to need a Bybit account. Now, if you don't already have a Bybit account, there is a link down below. It will give you some sign up bonuses. And in addition to that, if you use that specific link, you will also get access to the 𝗧𝗿𝗃𝗵 Discord, where we discuss these kind of strategies all the time and we can help you out if you need it. Now, I know that Bybit is not available in all regions. So if you're not able to use Bybit, that doesn't mean that this strategy becomes irrelevant for you. There are other exchanges that you can use. So stay with me till the end of this video and I will go through a list of other exchanges that I've found. Now, before I get into this video, I need to explain to you what the term futures mean. You may or may not have heard of it, but it's very, very relevant for this strategy. In basic terms, a futures contract is an agreement to buy or sell an asset at a predetermined price in the future. And that future date is specified by the expiry date of the contract. So if you're familiar with leverage trading, then you've probably heard of the term perpetual contract. Both futures and perpetual offer you the opportunity to be able to borrow money, which is using leverage, in order to execute trades. So leverage trading essentially just means that you're only using a part of your own money, which is known as the margin, on any particular trade, and the rest of the money of that trade is borrowed money. In exchange for the ability to do this, the exchange will put in a liquidation point, and that essentially means that if a trade were to go against you, then there is a point where the exchange will automatically cut the trade to ensure that you don't lose any of the borrowed money. That borrowed money gets returned to the borrower, and all that you can lose on the trade is what you specifically put on the trade, being your margin. Depending on the exchange that you trade on, you could have a 1x up to 125x leverage available to you. And the X refers to how much of the position you're borrowing in relation to how much of your own margin that you're putting on that particular position. So for example, if you opened a trade on 10x leverage and the position was $1,000, $100 of that position would be your margin, your money, and the other 900 would be the borrowed money. Now, if that trade went the wrong way, the most you could lose would be the $100 of your money on that trade. The remaining 900 would be protected and it would go back to the market maker should the exchange liquidate you, to ensure that the market maker never loses. So for that reason, the higher the leverage that you use, the closer the liquidation point is going to be to your entry. And this is what makes high leverage dangerous if you don't practice really good risk management. And the higher the leverage you use, the more accurate you need to be with your trading. But for this method, we want to decrease our chances of getting liquidated as much as possible. And that's why it's really important for this strategy that we use super low leverage, because it's going to protect anything that we put on this trade, especially when the purpose of it is for us to accumulate more cryptocurrency, and we really don't want to be putting our purchased cryptocurrency at risk. Now let me explain to you the difference between perpetual and futures contracts. A perpetual contract runs forever, essentially. Once you open a trade on a perpetual contract, there is no expiry date, which means that if you really wanted to, you could hold it for months. In general, perpetual contracts also have much higher volume. So if you're market buying into your positions, then your spread is going to be a lot better. So you're going to end up getting a better entry price on most of your trades, as opposed to futures. The downside to perpetuals, however, is that for the privilege of being able to open leverage positions and hold them for a long time, you actually do incur an 8-hour funding fee. Now that fee, if you're holding a trade for an extended period of time, it can really add up to a lot of lost money that essentially takes away from your overall profit on that position if you do hold it for too long. So for that reason, with perpetual contracts, you really don't want to be holding your trades for longer than a few days in order to get the maximum benefit out of them. These fees are even worse on high leverage because the fee is based on a percentage of the overall position, not just the percentage of the margin being your money on the trade. So if you do plan to hold a position for an extended period of time using leverage, then you actually want to be using a futures contract. Now, a futures contract does have an expiry date, and usually you will know the expiry date by the ticker on the exchange. For example, it might say BTC USD 0329, and that would mean that that particular contract expires on the 29th of March. So you can hold your trade all the way up until that date, and if you don't close it before then, it will automatically get closed by the exchange on that date. Now, the advantage to this is that it doesn't come with the 8-hour funding fee. So you can hold a position for potentially months if you happen to catch a really good position, somewhere towards the bottom of the bear market, and you hold that through the higher highs and the high lows on a macro level. You can end up holding a position for 3 months, 4 months, 5 months, depending on the expiry date, and you're not copying that 8-hour funding fee that you would get on perpetual contracts. What the futures do instead is they build an interest rate into the price. So if you were to look at the price of Bitcoin on a futures contract, it may be a little bit higher than the perpetual contract. That's just the interest rate that allows you to be able to hold the position for so long, but it's not something you should worry about because the percentage move in Bitcoin is going to be the same. And so the profit and the loss and all of those things will be the same no matter which one you're choosing. It's just the added benefit if you're holding for longer that you don't incur those 8-hour funding fees if you use a futures contract. Now, futures contracts will have multiple expiry dates. You'll find that every 3 months there is one, and every 3 months they bring out a new one. So at the time of filming this, we have 2 options. There will be a futures contract that's expiring at the end of December, and then there'll be another one expiring at the end of March. For this strategy that I'm going to show you, you always want to be choosing the one that expires as furthest into the future as you possibly can, because that's going to give you the ability to hold it for as long as possible, should the trend be your friend. And the final thing to note about futures contracts is because they have that expiry date, on that date of that expiry, the price can become quite volatile. And that's because everybody has to close their trades on that date. Otherwise, they're going to automatically get closed. You never want to be in a position where your trade automatically gets closed. You always want to be in control of that. So for that reason, about 1 to 2 days before that expiry date of whatever contract you have a trade on, you want to make sure that you close the trade yourself so that you can get out at the best price possible. Now that you know all of these important details, there is one more element that makes this strategy an absolute game changer, and that comes down to USDT margin futures versus coin margin futures. Now, this is the part that not all exchanges offer. However, Bybit does offer it. So if you're able to use Bybit, be sure to grab the link in the description of this video to set up your account and be ready for this strategy that I'm about to show you. Most exchanges will have USDT futures or USDC futures, which essentially means that whatever asset you want to trade, let's just use Bitcoin as an example, you have to own USDT in order to open a position on that futures contract. And when that contract closes or you decide to exit that trade, your profit or your loss is going to be realized in USDT. So you're really only trading the price of Bitcoin. You're not actually gaining any more Bitcoin in that transaction. Of course, you can then go and take your USDT and physically buy Bitcoin if you wanted to. But if you think about it, if you're in a position where you got in cheap, you're selling at what you believe is a peak, then that would mean that in order to go and buy the Bitcoin spot, you would be buying the Bitcoin at a peak as well. So it doesn't really work. You would have to wait for price to pull back, and it's a 2-step process. But this is where coin margin futures is the actual game changer that led to that dot example that I showed you earlier. With coin margin futures, you're not using USDT to take your trades, you're using the actual asset itself. So first of all, you will need to own the asset. again, for example, Bitcoin. So you bought some Bitcoin spot and then you transfer that over to the derivatives exchange, which I'll show you how to do all of that in this video. And then once it's transferred over, you can open your position and you'll be using that Bitcoin as the margin on the trade. Now, why is this such a game changer? Because first of all, if the underlying asset is bullish and is growing in value, then you're gaining from the percentage increases of the asset itself. But at the same time, your long position is making you more Bitcoin, so that eventually when you decide to close the trade and take profit, not only has your Bitcoin increased in value, but you also now have more Bitcoin that is also worth more. It's like a double win. Let's compare that to a USDT margin contract where the underlying asset is USDT. It's not Bitcoin. So therefore, it's a stable coin. So as Bitcoin's going up in value, you're not gaining anything from the margin that you put on that trade. And that's what makes coin futures the game changer, because you've got the asset going up, you've got it on low leverage, and you're gaining more of the asset as well. By the time you finish that trade, you've got more of it and it's worth more. Let me show you a real life example in order to make this make sense. So this is a coin margin futures trade that I've just opened on Bybit, and you can see here that it's a Bitcoin trade and the ticker is BTC USD 0329. So that 0329 is the expiry date of this contract, meaning I must close this trade before that date or it will be closed on my behalf. You can also see that I'm on a 5x leverage and the current value of this order is 0.3857 Bitcoin, and the margin on the trade, which is my money that I've got on this trade, is 0.0774 Bitcoin. That's currently valued at about $2,737 US dollars. And here you can see that this trade is currently up 8% on the 5x leverage, and the unrealized P&L is 0.0064 BTC, which means if I were to close this trade right now, I will gain 0.0064 BTC, which is currently about 227 US dollars. Now this trade has just started. You can see my entry is right here and my stop loss is under these wicks right here. So hopefully by now you're starting to see that the benefit of using coin margin futures contract, especially in a bull market, is that you actually end up with a double gain. So you have the benefit of the asset itself going up in value, plus you're making more of that asset using low leverage. The only downside to this strategy is that most exchanges don't offer many coin options in order to do this. However, in the last bull market, more and more became available as the market became more and more bullish. So currently Bybit only offers this option for Bitcoin and Ethereum, but I'm sure that more is going to be added over time. And at the end of the day, every portfolio should be Bitcoin and Ethereum heavy anyway. And this is a really good free way to do it without you having to physically buy Bitcoin and Ethereum at every dip or every week or however you decide to dollar cost average into those things. Now, let me show you exactly how to set all of this up on Bybit and get yourself from buying spot to being able to open a position using coin futures. So in order to set yourself up to be able to do a trade like this, you need to first buy your Bitcoin spot. If you already have Bitcoin or Ethereum, you can just transfer it in, or it may already be on the exchange. But if you need to buy it, you'll come up to the trade tab, spot trading, and then from the list, you can just choose Bitcoin or Ethereum, whichever one you want to buy. And then over here on the right-hand side, you will need to either limit buy or market buy, decide how much of it you want to buy. I don't have anything left in my spot account on this, so I can only buy $10 worth of Bitcoin, and then just hit the buy button. Now you have spot BTC. So if you go to your wallet and click on spot, you should be able to see that Bitcoin that you just purchased right here. Now what you need to do from there is you need to then transfer it over to your derivatives wallet. So you click on the transfer and you go from spot to derivatives. Decide how much you want to transfer and click confirm. Now we're ready to set up our coin futures trade. So we're going to go over here to the derivatives tab and you're going to scroll down until you see inverse contract. And then again, over here on the left-hand side, you want to hover over this, go to where you see inverse, and then click on inverse futures. Now, to make it easy, you can just star these so that they stay in your favorites list. But you can see here that you've got Ethereum and Bitcoin as your only options currently. And you've got the 1229, which means that these two expire on the 29th of December. And then you've got these two here that are 0329 expiring on the 29th of March. So you always want to choose the one that's most furthest in the future. I'm going to choose Ethereum because I already have a Bitcoin one going. And this is where I would open my Ethereum trade. So if I were to believe that Ethereum was going up from here, I could either put in a limit order and decide the price that I want to buy at. Let's just say I want to buy at 1920, and I want to come up here where it says isolated or cross. Click on that. Always make sure it's on isolated. Click confirm. And then your leverage as well, make sure that is on between a 2 to 5x leverage. You don't want to be going higher than 5x for this strategy. Then you can decide how much you want to put on this trade. And then you're going to hit the take profit stop loss. I want to put my stop loss under this wick. So I'm going to put my stop loss at about 1894. So you click on this button. I'm not going to put a take profit because I want to hold this for the long term. So I'm going to put my stop loss at 1894. And then it will show me here what my loss will be if it goes the wrong way. If I'm happy with that, click confirm. Now everything is ready there. I can double check it and then just click on post only, which means that this will only execute after I have put this order in, and click on buy long. Now, whilst I'm waiting for that order to get filled, I can come over here to the current orders tab and I can see that it's sitting there waiting to get filled. If price does happen to come down to 1920, it will trigger my order, and then I will be in for a long position, and I'll be able to find that under the positions tab like I can see my current Bitcoin order. Finally, when a couple months goes by, hopefully we are actually in a bull market and I'm ready to take my final profit on this, I can just come over here to this section where it says close by limit or market, and I can click on limit to put the price that I want to exit, or I can click on market if I just want to exit immediately. Now, as I promised, if you stayed with me till the end of this video, I would show you a list of exchanges that I have found that you can do this on. There may be more, but these are the ones that I found in the event that you can't use Bybit. I will list them here. And don't forget to check out the links in the description of this video, as there may be some bonus offers for some of those exchanges that help you out getting signed up. Here's some examples of some other trades that I've actually been holding for a while on this strategy. This is on a different exchange, but on this one, you can see I've been holding XRP. I have a 17,608 XRP position. I used 4,420 XRP. That was my margin on the trade. It is a 5x leverage trade. I'm currently up 100% on this trade, and I've gained 4,493 XRP. So when my margin was 4,420 and I've gained 4,490, I've doubled my XRP on this trade so far. The next one is Ethereum, where the size of the position is 8.58 ETH. Margin is 2.13 ETH. So that's my money on the trade. It is currently up 98%, and I have made 2.11 ETH, meaning I have also doubled my Ethereum on this current trade. Finally, I have a Bitcoin position, 1 Bitcoin worth. My margin on the trade is 0.248 BTC. This one is only up 59%, but this one I have been adding to the trade on the way up. That's probably another video for me to explain how you do that. But leave me a comment down below if you want me to do a video on how to average into trades that are going well for you to increase your profits. I'm happy to do that. And on this trade, I have currently gained 0.14 BTC. So about half the amount of the Bitcoin that I have on this trade. If you learned something new from this video and you're going to try this yourself, be sure to hit the like button and leave me a comment down below and let me know what you think. I'll see you on the next video.